My mission is simple, to make you money. I'm here to level the playing field for all investors. There's always a bull market somewhere, and I promise to help you find it. Mad Money starts now. Hey, I'm Cramer. Welcome to Mad Money. Welcome to Cramerica. Other people make friends. I'm just trying to make a little money. My job is not just to entertain you, but to educate, teach you. So call me at 1-800-743-CNBC. Tweet me at Jim Cramer. Memo to the Fed. Be careful what you wish for, because you may already be getting it. Today we got the minutes of the Fed meeting from April 30th to May 1st. I know these are now rearview mirror pros, but Wall Street obsesses on anything the Fed does. And when the minutes reflected a harsh review on inflation, the market got clubbed. With Dow tumbling 202 points, S&P sinking 0.27%, Nasdaq climbed 0.18%. Now, we've been doing fine today until these remarks were released. And then we had this sudden drop, even as the minutes reflect negative data long since forgotten. Now, what the heck did the Fed say 3 weeks ago that could scare the market so badly? Look, these Fed officials were lamenting that inflation hasn't come down fast enough and might even be ticking up. Ever since the Fed pivoted last fall into a stance of no more rate hikes, which then caused the stock market to go up. Well, the Fed's been waiting for inflation to roll over. Today's minutes indicated they've become impatient with the pace of decline. They were hoping it would go down faster. Hey, so is everyone else. But in the 3 weeks since the Fed meeting occurred, guess what? The minutes that the meeting reflected, everything's going the Fed's way. Just consider these inflation wins post-meeting. We got a labor report that indicated the economy was cooling, wages had stabilized, usually important report. And if the Fed had seen these numbers ahead of time, I bet there would have been a lot less hand-wringing. The minutes might have actually been positive. After that, we got a cooler than expected consumer price index reading. Then we had a dramatically weaker retail sales number, much lower than expected. Again, I think the Fed officials would have sung a different, more positive tune if they had seen these numbers ahead. At the time of the last Fed meeting, we were dealing with nascent commodity inflation. Oil had spiked. Copper had broken out. Now, oil, aided by a surprise draining of the Strategic Petroleum Reserve, it looks like it's breaking down. Copper, which had been on a furious tear, some say a short squeeze, got pancaked today. That matters because copper doesn't spike unless the global economy is really heating up. Copper's used in housing, especially in China, and electric vehicles and data centers. Traders use Freeport-McMoRan FCX as our largest copper producer, proxy for it. It's been straight up until today, when the stock was down more than 5%. I'm not concerned about copper. It's abundant. All you got to do is dig a little more. Yeah, oil and copper going the Fed's way. So, how about the consumer? Two-thirds of our economy is based on the consumer. The consumer's been so robust, I'm sure there are some incredibly frustrated people at the Fed. And you can hear them saying, what will it take to get this consumer to stop spending? Is there any price that's too high for them? Or have they become so accepting of inflation they just don't care and won't rebel? And that is the problem that we've seen with countries that have embedded inflation. When these officials looked at the consumer 3 weeks ago, they probably felt like the Fed should never have stopped tightening. Because without a pullback in consumer spending, we can't beat inflation, particularly when we have such good job growth. I know the various Fed governors and regional Fed presidents love to give speeches and interviews. They love the limelight. They certainly aren't shy. Some of them may be gas bags. They all seem like failed actors and actresses. But if they'd taken a moment from speaking and actually look at the companies that are leading indicators, they'd recognize that they're finally winning the war with the consumer spend, too. No victory lap. But we're getting nascent signs that enough is enough. There's some buyer strikes. Let's take Walmart, reported a great quarter, in part thanks to its booming grocery business. Remember, they're the largest grocer in America, and their sales are extraordinarily strong, maybe too strong. What's driving that? When you dig, when you come up with that, after years of seemingly endless price increases, the consumer has had enough. The consumer is now staying more at home. Unless you can offer me some sort of deal, an $11 steal like at Texas Roadhouse or Brinker's Chili's, I'm just going to go to Walmart, throw in a couple of steaks on the Traeger or maybe the Weber, especially now it's nice out. People want value now. Walmart's one of the few that are offering it. It's happening right now. Hey, TJX was doing really terrific. You don't do really terrific at TJX unless you're saying, I'm not going to Macy's. Although I like that Macy's quarter. What else? Apparently, the franchisees of McDonald's are grousing at the company's forcing a $5 value meal down their throats. I'm sure there's some areas where there's no resistance to higher prices, but those are exceptions. When you look at McDonald's as a whole, it's clear people have had enough of their raising price, too. They need that $5 value meal to boost traffic. I wonder if the Fed's heads have spotted the cheaper burger and cheered it. It's part of the overall buyer strike. They had to swing by McDonald's. Could be good for them. We'll hear directly from the source, the biggest restaurant supplier in the country, tonight, Cisco. And I think they're going to tell a story of newfound resistance to higher prices. And now, how do I say that? Because listen to what CEO Kevin Hurricane at this analyst day said, and I'm quoting, "It is our belief that restaurant menu prices have impacted foot traffic, and this is something that needs to be addressed more broadly by the industry," end quote. He goes on, quote, "The industry needs to take action to improve affordability for end consumers," end quote. Hey, Hey, come on. That's the budding consumer rebellion. Now, we're not seeing a buyer strike just yet everywhere. Last night, Toll Brothers reported a very good quarter, sold a ton of homes at $1 million a pop, getting that price down for a while. Toll's earnings are so juicy, the company finally increased its building of new homes. Stock popped on the news. But then today, the skeptics jump in, immediately wondering, wait a second, maybe Toll's going to build too many homes. Maybe there's going to be some supply at last. They question whether there's at last some resistance to price at the $1 million mark, because it's been there for a couple of weeks. They think the housing cycle may be over, so they want to get out of the best home builder before the cracks occur, so the stock goes down 11 points or 8.5%. Oh, and there's also the anecdotal. Target sells goods that are pricier than Walmart. Target delivers inline earnings. Walmart gave us much better than expected numbers. Is that the consumer beginning to rebel? Target stock goes down 12 or 8%. Lulu stock's been going down for ages, but could that be the consumer opting for cheaper athleisure? Could be. Lulu stock plummets $23 or 7.2%. Fed, listen up. There are suddenly buyer strikes all over the place. Now, all of this actual macro activity is vying for headlines with Nvidia. And when the third largest company on earth reported it delivered another great quarter, a big top and bottom line beat with management issuing a better than expected outlook for the current quarter, well, the stock jumped in after hours trading, even better for individual investors, not necessarily the institutions. They announced a 10-for-1 stock split and boosted the dividend from 4 cents to 10 cents per quarter, which will actually be 1 cent per share post-split. The stock got a boost in after hours trading, but not by an insane amount, because Nvidia, well, let's just say it's in the habit of blowing away the numbers. Oh, and DuPont, let's not forget that. Chemical, healthcare, electronics, and water company decided tonight's going to split into 3 companies. It's a huge win for Ed Breen, the now outgoing CEO, and for shareholders like my charitable trust. Tomorrow, it will matter regardless of those meeting notes, and I will certainly fill everybody in this evening who are members of the club about what it means. Bottom line, for the part of the market that isn't tech or industrials like DuPont, for the part of the market that was consumer-oriented, today was a day when the Fed won. Let's hope the Fed conclave realizes that their inflation lamentation from 3 weeks ago may no longer be necessary. If they don't, and they stay upset about the prospects for deflation just when it's finally happening, then we might have quite a few more days like this one. Why don't we start with Josh in Alabama? Josh.
Hey, Jim. How are you?
I'm good, Josh. How are you doing?
I'm good. Thank you for taking my call.
Of course.
First time, long time, and a club member. And I say that because I want to thank you and your team for all the hard work that you put in every day to teach us and steer us towards financial freedom.
Thank you. And Jeff Marks and Jeff Vima right now working on DuPont, working on Nvidia, trying to bring it to you because that's what matters. How can I help?
Jim, my question is about Disney. I've had a long position in Disney for several years now, and over the past couple of years, I've continued to add to the position as the stock has slid down and to the right. Despite Bob Iger's return, the company has still had an underperformance in the market. And understanding how tight the streaming market is, do you think that the other revenue streams, including parks, are enough to stay in the stock?
All right. Well, we got to blow out a lot of Disney for the club when it was higher. Thank you, Nelson Peltz, for doing that, although I think he doesn't get enough credit for actually moving the stock higher. It's now all the way back down where we are inclined at $100 to buy more. So if we're inclined to buy it and you're a club member, then you know this is a very good level. The stock has gotten too cheap. Let's go to John in Washington. John.
Booyah, Jimmy Chill. This is John from beautiful Seattle, Washington.
I am feeling chill.
I want to know what your thoughts are on Rivian, baby.
Rivian. Okay, my wife wants to buy one. She looked at the stock price. She says, hey, are they going to be in business? Don't worry about Rivian. They have a lot of money coming out their way. But I'm glad she didn't say she wanted to lose it. Let's put it like that. All right, how about Jackson in North Carolina? Jack.
Hey, how's it going?
It's good. It's good. How about you?
Doing pretty good. Pretty good.
Good. I want to be sure.
Sounds good.
No problem.
All right. So what do you think about the future of ARM Holdings? Not the last earnings report wasn't the best, but
no, you're right. But you know what? Let's Jack. Let's give. First of all, the stock is up since Renee gave you that quarter. Second, I'll say this about Renee, man. That he gave you a good price for that underwriting. It is going. Gave all the way up, went all the way up, and then gave back some. But they are here to stay, and that is maybe one of the highest growth companies. I think it's a lot better than Qualcomm. Everybody's all crazy about Qualcomm. I'm backing with Renee. I think he's real good. All right, listen to me. For the part of the market that is consumer-oriented, today was a day where the Fed won, and that's 2/3 of the economy. Let's just hope they realize that their regrets over inflation from nearly a month ago may not be necessary at this point in the cycle. On Mad Money tonight, Williams-Sonoma reported a strong quarter before the bell, and the stock shot up to an all-time high. But throughout the session, there was buyer's remorse. Stock finished lower. I'm sitting down with the CEO, get a better read. Then Cisco, we just mentioned, the SYY kind, reported a disappointing quarter last month. So I'm checking out what's happening at that company, giant restaurant supplier. Are they seeing less foot traffic? And later, Snowflake CEO is going to be fresh off the company's call, real fresh, to break down what we should make of his tech quarter. Remember, tech's doing well. Go Nvidia. It's David Cramer.
Don't miss a second of Mad Money. Follow @Jim Cramer on X. Have a question? Tweet Cramer. #MadMentions. Send Jim an email to madmoney@cnbc.com or give us a call at 1-800-743-CNBC. Miss something? Head to madmoney.cnbc.com.